Hello and welcome back, guys. So in this particular session, what we'll be discussing about is garden. Okay, so it's from SPR's exam kit. So I've been having problem with this Loom for a while, my video recording app. So let's see if it works out. I'm using the desktop version. So whenever I pause and then I play it, the video does not record. So anyways, so in this particular session, what we'll be discussing about is share-based payment of Garden. Okay, so what has basically happened is that Garden is a public limited company with a reporting date of 30th November 2006. It operates various online businesses. Its customer order goods through Garden's website, and these goods are delivered by third-party couriers. Okay, so it's outsourced. At 30th November 2006, the finance director owns 15% of the Garden's ordinary shares and the operational director owns 10%. The rest of the shares are owned by numerous other shareholders. All ordinary shares carry equal voting rights. At the most recent annual general meeting, some of the shareholders expressed dissatisfaction with the financial performance of Garden. They also complained that the directors were overpaid and were not demonstrating effective stewardship of the company's asset. Overpaid and were not demonstrating effective stewardship, right? The accountant of Garden started her employment during the year ended 30th November 2006 and has encountered a number of issues. Okay. Share-based payment. On 1st December 2005, a share-based payment scheme was introduced for Garden's 6 directors. The directors are entitled to 600,000 share options, each if they remained employed by the company until 30th November 2008. So they have to work over there for 3 years. For 6 directors, right, entitled to 600 share options if they work until that, right? So it's service based, right? And then the fair value of each share options was $4 at 1st December 2005. This will be very important because since it is equity settled share based payment. So $5 at 30th November 2006. At 1st December 2005, it was estimated that none of the directors would leave before the year of 3 years, but as at 30th November 2006, the estimated number of share leavers was revised to 1. Okay, so 6 minus 1, 5. The finance director has told the accountant that no entries or disclosures are required for this scheme in the current year's financial statement because it has not yet vested, right? So let's talk about it. Share-based payment. If the directors have been granted share options so this is an equity settled share-based payment transaction, right? According to IFRS 2, share-based payment the expense should be based on the fair value of the options at granted. That is $4, right? Expense should be spread over how many period is it? 3 years, right? 3 years. Vesting period based upon number of options expected to vest, right? One third of the vesting period has passed, so the finance director is incorrect in stating no expense shall be recognized, right? Be recognized in the current financial year. The expense that should be recognized in the year ended 30 November 20x. What was it? 20x6 x6 is how many directors? 5 directors, right? 6 minus 1. Directors into 600,000 options into $4 into 1 divided by 3, right? Is equals to $4 million, right? So 3, 4, yep, 4 million. Share based and stating, right? So this 4 million should be recognized in SOPL, right? And therefore, an expense of $4 million should be recognized in profit or loss and a corresponding entry made to equity. This will reduce the reported profit of garden. Alright, and then it is about IAS 24 as well. Related party disclosure, right? Requires that all but key management personnel which includes all directors are related party of the reporting entity with regards to key management personnel. An entity must disclose employee benefits, including share-based payments, right? So let's look at the other issue. What's there? Okay, so the next issue being the director's son, right? And the director's son, bold it, the director's son. So what has happened with the son? Let's look at it. So the wife of finance director is the sales director of Garden. The son is undertaking an internship with Garden and receives a salary of 30,000 per annum. Okay, so it's a sales director, and then the son is undertaking an internship with Garden, which is in line with market rates. The viceroy has ordered the accountant to omit any reference to son's salary from the financial statement. Directors are key management personnel and therefore are related party of the reporting entity, right? IAS 24 says that close family members of key management personnel would be related party, also would be related parties of the reporting entity, which includes children too. Right? The son of finance director and sales director let's say one director, right? Finance and sales directors is therefore a related party of garden. The salary paid to him would need to be disclosed in the notes. A statement could be made that the transaction is on market value terms as long as it is substantiated. Okay, stated. Okay, so let's look at other issues. What has happened? The other issue is operating segments, right? So at the start of the year, Golden purchased the trade and assets of finance fashion retail chain that operates a number of shops in large towns and cities. The chain did not sell its products online. Press were critical of Garden's decision, accusing them of overpaying for the chain and expanding into sector in which they lack experience and expertise. The performance of the shops, which is monitored internally by Gordon's chief operating decision makers, has been poor. When reviewing the operating segments disclosure note prepared by financial director, the accountant noticed that the news retail business has been aggregated with the rest of the trading operations and disclosed as a single reportable segment. Okay. The gross profit margins made from retail outlets are much lower than those made from Garden's online operation. From overhearing conversations, the accountant is aware that finance director is good friend of the former owner of the retail chain. Okay. So operating segments. Right, so we need to give them the details of operating segments first of all. According to IFRS 8, operating segments an operating segment is a component of entity that engages in business activities and which has discrete financial information available that is monitored by the entity's chief decision maker would seem that the retail outlets are an operating segment. Right. Operating segments can be aggregated if they have similar economic characteristics. Such segments would normally have similar long-term margins and also be product. Such segments would normally have similar long-term margins and would also be in similar terms, also be similar in terms of product that they sell. Customers that they sell to all should be similar. Okay, kind of economic characteristics we are talking about? Long-term margins, similar in terms of product they sell, the customer that they sell, the distribution method used. And this is also different, right? It was not her online store earlier. The retail outlet have a different margin to the rest of gardens activities. Furthermore, the retail stores sell to customers face to face, whereas the rest of gardens business is conducted online. With goods dispatched to customers via couriers, right? Third party couriers. This suggests that the retail outlet do not have similar economic characteristics similar to the other operating segments. As such, the retail outlets should be disclosed as a separate segment. Assuming that they exceed the quantitative threshold outlined in IFRS 8, right? Normally it's 10%, right? Okay, so once that's done, let's talk about IAS 24 again. Related party disclosures. Says that a close family member of a director is a related party. The reporting entity. Whose member of director is a related party of reporting entity. However, the definition of close family member does not include friends, right? So just friends with the other fellow, right? Isn't it? Yeah. Good friend. This means that the purchase of the trade and assets retail business should not be disclosed as separate as related party disclosure, right? A related party transaction, I mean, it should not be disclosed as a related party transaction. Right. So next issues will be ethical and professional issues, right? So what does it say over here? Okay, so let's talk about ethical and professional issues as well. So first thing first, purpose of financial statement is to give a fair representation of the company's performance and position to enable investors, lenders, and other users make decision, right? That's our primary purpose. Accountants have a social and ethical responsibility to issue financial statement which do not mislead the public, deliberate falsification of financial statement is unethical. Any manipulation of the accounts will harm the credibility of profession, since the public assume that professional accountants will act in an ethical capacity. Financial responsibility, financial falsification of financial statements, right? Okay, so fair representation is normally deemed to have been provided if the financial statements are prepared in accordance with IFRS or IAS, right? It would seem that the financial statement currently breach a number of standards such as IFRS 2, IAS 24, and IFRS 8. We could write it down as well, but not really necessary, okay? So 2 is share best, and then 24 is, IAS 24 is related party disclosure, operating segments, right? Omitting the share based payment transaction from the financial statements has inflated profit for the year, which could impact shareholders' perception regarding the performance of garden. Moreover, the shareholders have already been critical about directors' remuneration, so omitting the transaction may have been a tactic for deliberately concealing additional benefit. It would also seem that the recruitment and remuneration of the son of the finance and sales directors is being deliberately concealed, although it is claimed that he is being paid a salary that is in line with market rates, right? Question may be asked, about the appointment such as best person for the job, is this role really required, is this the best use of company's money, some users financial statement might conclude that the directors are putting their own interest and the interests of family members above those of the other company shareholders. Gardens finance director has wrongly aggregated the entities operating segments. This might be an attempt hide the poor performance of the newly acquired retail outlets, thus avoiding further criticisms and scrutiny of the transaction. Right, it could be that, and then whilst the trade and assets were not purchased from a related party, the fact that transaction took place with a close friend of one of the directors raises questions about integrity and the extent to which the directors more generally are effectively and efficiently using the entity's resources, okay? So that is also doubtful, right? The accountant should remind the directors that professional ethics are an integral part framework from which professional accountants operate. They must adhere to ethical guidelines such as ACCA's Code of Ethics and Conduct. It would appear that the financial statements are being deliberately manipulated probably to avoid further criticisms from shareholders about the running of the company and the stewardship of its assets. This would contravene principles of integrity, objectivity, and professional behavior. We could say competence as well, because we did not make that argument, right? So we did not say if it was not deliberate, then it could be because of lack of knowledge. We could have said that, but we have not actually talked about it. So let's not write it as well. Okay, so once this has been written, so what else do we need to so records discussion between the accountant and the directors should be kept, and if these agreements remain, advice should be sought by the accountant from ACCA. If no channel for internal reporting concerns exists, then the accountant may need to consider resignation, right? Even if the external auditors, any executive directors, non-executive directors, even if they don't do anything about it, then that's the last thing that accountant can do, right? Is consider resignation. Okay, so I'll just correct my mistakes. So this is basically how we answer this kind of question. Okay, so we need to basically be very particular. So see what kind of questions we could be asking about the sun and stuff as well. So need to be very vigilant with every word the question. So that's it pretty much, guys. So I guess how this question is finished. So next question will be regarding cherry, question number 21, and then after that we will have one more question in 22, and that should basically finish our section A questions, right? That should basically finish our ethical related questions. So yeah, and there will be next two questions, and after that we will move on to section B questions. Okay, so if you have any confusions until now or any other questions, I will be more than happy to answer it. So please do comment down below. I'll definitely be looking forward for your comments. So until next time, bye bye.